There are so many big stories today. I struggled to pick one to talk about. I mean, you've got so-called vaccine breakthroughs or infection breakthroughs in Massachusetts that the media is all up in arms about, which is an interesting story. I mean, the media coverage of it is of itself a very interesting story. You've got the Australian government calling in the military to crush the opposition. That's pretty significant. Anyone who's standing up against medical martial law is going to have the Australian military sicked on them. That's your job when you sign up to be a soldier to defend Australia. What you signed up for was enforcing medical martial law. That's a pretty big thing. But those two stories, I trust that there will be people who are going to give the proper treatment to those stories, and so I feel all right putting them aside, at least for today. I might talk about them over the weekend, in favor of talking about a massive milestone that we just passed, and that was $1 trillion in reverse repos. As much as I've talked about the repo market on this channel, and as much as I've talked through and learned, along with anyone who's been following this channel for a while, I would be doing a major disservice if I did not give this major date the attention it deserves. We've been talking about the lead up to this for quite a while now, and I think now that we finally reached this milestone, I understand now more than ever the significance of it. And I think that it actually relates to something else that the Fed announced at the past FOMC meeting. It feels like it was a while ago, but I'm pretty sure that was this week, wasn't it? Where they announced the, I guess you would call it the opening of the Fed's standing repo facility. And so I think I'm starting to put the pieces together. So hear me out, but the way that I understand this, what I think is going on, if you look at the reverse repo counterparties, who are they? Who are the people going to the Fed and engaging in these reverse repos? Which, for those, I guess I should explain reverse repos in every video just in case. A reverse repo basically means a financial institution is going to the Fed, giving the Fed money, and then the Fed is giving them securities, usually treasury bills, overnight. And so it's like they're lending the Fed money overnight, and the Fed is using all of these treasuries on their balance sheet that they've purchased through quantitative easing as collateral. Now, the people who are engaging in the reverse repo, these institutions, cannot do anything with these treasuries that the Fed is putting up as collateral. They're not allowed to take those treasuries and then rehypothecate them. They can't borrow against the treasuries that are that the Fed puts up as collateral. So the only institutions that we see engaging in reverse repo are money market funds who only care about gaining some sort of positive yield, even if it is as small as 5 basis points, which is what the Fed offers. It's better than zero, and the money market funds are entities that are not looking to rehypothecate treasuries. So you'll never see a hedge fund, for example, engage in reverse repo. Now, why are these money market funds engaging in reverse repos with the Fed rather than just lending their money out in the private repo market to, say a hedge fund or a bank or whoever happens to be looking to borrow money in the repo market and put up collateral overnight for an overnight loan? And the answer would be, even if in the private repo market you can make more than 5 basis points, there is zero risk to lending money to the Fed. And so if these money market funds are rotating out of the private repo market into reverse repos with the Fed, that means that to them the risk-reward ratio just doesn't add up for the private repo space. Either they cannot get a high enough yield to justify the risk that they see, the counterparty risk in the private repo market, or even if the yield is high enough to justify the risk, to them they just don't want to take on that much risk because a money market fund is, by nature, supposed to be like a savings account. It's not supposed to be the kind of fund that takes on any real risks. Money market funds engage in ultra short-term lending that's supposed to be very safe and very secure. And so if they don't find enough opportunities to lend in the private repo market, that would indicate that these private entities, hedge funds, other banks, whoever, private equity firms, they do not have enough pristine collateral. The money market funds are looking at what's being offered in the repo market, and again, this is my opinion and the opinion of other people based on what I've studied. This is how I gather the situation, what we're dealing with right now. The money market funds are looking at what's being offered in the repo market, and there just isn't good enough collateral being offered up. Let's say instead of treasury bills, they might be offering up corporate bonds. Investment-grade corporate bonds, but an investment-grade corporate bond is not a treasury. And the money market fund likely will balk at that at any price. Or maybe it's a mortgage-backed security. I don't know. I'm not in there. I'm not running the money market funds. I don't know exactly what they're looking at. But obviously what the Fed is offering is more attractive to them. So we can infer from that, based on their demonstrated preference to engage in reverse repo over private sector repos, there is not enough pristine collateral in the private repo market to entice all of these money market funds to lend all of their cash into that market. So what we're seeing in the reverse repo market, as it has now broken through that $1 trillion mark and continually, it seems like every week there has not been a single week where reverse repos have been down week over week. It seems like every single week it's higher and higher and higher. It's not quite every day. Sometimes you'll have one day where it's lower than the day before, but it keeps on going up very steadily. If there was a reverse repo ETF that tracked the growth of the reverse repo at the Fed, that would be a AAA buy. Because nothing makes it go down. It just keeps on going up and up and up. And so that tells me that these money market funds, because it's the same money market funds that keep going back to the Fed every day to engage in reverse repo, they are finding less and less attractive opportunities in the private repo market. Collateral is becoming more and more scarce. In other words, risk is rising. And so where does that leave the would-be borrowers who are going into the repo market trying to borrow money from these money market funds who are now all having their dollars sucked up by the Fed like a giant vacuum? Well, now there are folks in the repo market who otherwise would have been funded who no longer can. There's $1 trillion missing from the repo market. This $1 trillion in reverse repos, if it wasn't, at the Fed, theoretically, it would be in the repo market. So how do you make up for that gap? And the only answer is the Fed's standing repo facility. If these repo market counterparties, if these hedge funds, private equity groups, banks, shadow banks, whatever the entity is that is trying to borrow money in the repo market, can't get money lent to them by money market funds, well, then they can go to the Fed. Now, there are a couple of issues with the Fed's standing repo facility, I don't think that it is a, well, first of all, none of this is good for the market, I'll put it that way. These are band-aids over band-aids over band-aids over band-aids trying to keep a bubble from letting out any of its air, let alone completely popping. So the first issue is the rate associated with this standing repo facility. If anyone wants to borrow from it, they're going to have to pay 25 basis points, and that's annualized, which is a lot higher than the reverse repo rate, which in and of itself doesn't really matter, because I guess in theory, the Fed doesn't want both the standing repo facility and the, which again, these two facilities do different things. They're targeted at people on opposite sides of repo market transactions. The standing repo facility is targeted at people who want to borrow money. The reverse repo facility is targeted at people who want to lend money. And so the Fed doesn't want to, I guess in theory, overly incentivize and make these too attractive to their respective constituencies. And so they gave the reserve repo facility a very, very low rate of return at 5 basis points, and for people who want to borrow money, they have to pay a relatively high interest rate at 25 basis points. Now, this still might get a lot of use, I think, because what is considered to be pristine collateral by these money market funds, they might have much higher standards than the Fed, because the Fed doesn't use the language pristine. The Fed just says, hey, treasuries, agency-backed security, I forget the exact phraseology for the second one, but there's some kind of U.S. government agency-backed debt, and of course agency MBS, which means mortgage-backed securities that are packaged up by government agencies like Fannie or Freddie. And so let's just skip over the middle one, because I don't entirely understand it or remember the acronym. So let's just say treasuries and mortgage-backed securities. Within the treasury market and mortgage-backed security market, there is a hierarchy of most to least pristine to best to worst forms of collateral, and the best collateral you can have are on-the-run treasuries, meaning the most recent issuance, the freshest treasuries. And so if you have, let's say, a 10-year bond that was issued in 2018, that's not as good of a collateral as a 10-year bond that was issued this year or a couple months ago or this month or whenever the last time there was a 10-year treasury auction. And so since the Fed just has this flat rate of 25 basis points, well, people who may have been trying to put up off-the-run treasuries in the repo market as collateral, which the money market funds were balking at and saying, no, I'm just going to go put my money in the reverse repo at the Fed. Maybe a lot of these folks, maybe this opens up a lot more folks to being able to get funding. Same thing is true with the mortgage-backed securities. Maybe there's a lot of mortgage-backed securities that these money market funds are saying, you know what, for the risk, I'd much rather just go park my money at the Fed. And so I don't know for certain yet, but we will have to see. We'll wait and see here if all of this money that's being sucked out of the repo market by the reverse repo facility is in fact pumped back into the repo market through the standing repo facility. And you might notice a pattern here. What is reverse repo other than the Fed unwinding QE? And what is a standing repo facility other than the Fed unwinding reverse repo? The Fed keeps creating all of these different facilities within the Federal Reserve System. All of these different desks, I guess you would call them if they were a investment bank, to paper over the damages inflicted upon the markets by other Fed facilities. And this really is sort of a microcosm of state intervention in the economy in general. So just about every new state intervention in the economy that comes down the pike is inevitably going to be an answer to a problem that was created by a previous state intervention. And so the Fed is doing all this QE. They're doing QE infinity. We're way past QE4. I don't even know how long ago you would say QE4 would have started. So we're on to QE infinity, and the Fed, finds out, oh, gee, we're sucking too much collateral out of the repo market. What do? Oh, let's open a reverse repo facility so that we can give the money market funds a place to invest their money, because there's not enough good collateral being put up in the repo market, and the money markets feel unsafe. Well, now they're doing that, and they suck $1 trillion out of the repo market, and then all of the repo market participants who are looking to borrow money are saying, hey, I can't get any credit. And so the Fed goes, oh, darn, I guess we'll have to open a standing repo facility because the repo market doesn't work. See, the Fed, we have to correct for market failures, and the market is just failing to provide enough credit to these would-be repo market participants. And so we, the Fed, in all our infinite wisdom, will come in and fix that and supply these folks with credit. And that is going to create another problem. I haven't thought through exactly what the latest problem will be, but that'll lead to a whole nother issue. And then the Fed will have to create some other, new facility. Probably what the Fed will end up having to do is expand the standing repo facility in order to, to accept first investment-grade corporate bonds, then junk bonds. Then they might even start taking equities as collateral, and eventually derivatives. Because that's the nature of this system. The only way that the price of everything, that all securities keeps going up, is that they keep rehypothecating securities. And once you've rehypothecated all the treasuries, 30 times, you need to start finding new assets to rehypothecate. Then you rehypothecate mortgage-backed securities. Then you rehypothecate all of the investment-grade corporate bonds, and so on and so on and so on. And this is how you keep inflating asset markets. You have to create more and more demand by creating more and more money out of thin air. It's like fractional reserve banking, except it's only occurring in financial markets. And so I wouldn't expect the reverse repo facility to shrink, or I wouldn't expect the reverse repo number, the daily reverse repos, to shrink anytime soon. I would expect those to continue growing, but now we should expect the standing repo facility to start growing as well. And in time, let's say maybe the next time that the stock market drops 5% or 10%, the Fed is going to expand the standing repo facility so that they accept more risky forms of collateral. After all, once upon a time, the Fed didn't accept mortgage-backed securities or anything like that. The Fed was only ever supposed to buy treasuries. That was supposed to be all that was on the Fed's balance sheet. Well, after 2008, the Fed said, okay, we're going to start buying mortgage-backed securities through quantitative easing. And then even last year, for a very short time, they created a so-called special purpose vehicle to purchase junk bonds. None of this is in the Federal Reserve Act. It's all totally illegal. But the Fed doesn't care. They're going to do whatever they want. And so if the Fed wants to lend people money in the repo market using SPY calls as collateral, the Fed can do it. So I think that's where I'll leave it off for today. I will see you folks back here tomorrow.